Rate cuts are coming up, so here are three stocks I think would benefit from these cuts quite a lot. These are companies that you probably know. You might not be interested in the sector, they're all in the same sector, they're all actually maybe even competing against each other. Those are companies that have done quite well when interest rates were at zero. Well, obviously, right? And these are, of course, real estate related companies. Yes, Redfin, Zillow, and Opendoor. You might click away. Don't do it for the sake of the analytics. Don't do it. If you're not interested, just mute me for the next couple of minutes. And for those that are interested, let's start with a couple of overviews from each and every company. Let's look at some numbers, and then let's conclude at the end of this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. Really appreciate that. For support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Alright, so let's start with the Zillow group. So the business Zillow is primarily known for its real estate marketplace. It offers a suite of services, including one, Zillow.com, a platform where people can search for homes for sale or rent, get home value estimates, Zestimates, and find real estate agents. Zillow offers iBuying, although just a second, a service where Zillow buys and sells homes directly, though they paused this in 2021 due to financial losses. They're not the only one out of the three. Premier Agent, a service that connects home buyers and sellers with local real estate agents. And the last one here, Mortgages, offers mortgage lending services through Zillow Home Loans. So Zillow looks a bit like this, has a market cap of $12.69 billion, forward P of 36.2 times. Year to date, it's down 4.4%. In the last 3 months, it's actually up 41%. You might ask, how does that make any sense, right? If you look at free cash flow, revenue, gross profit, net income, of course, it all peaked back in 2021. But right now, it's basically the anticipation for rate cuts. That's basically why the stock more recently started to go up. But the business right now, as you can see, it's not really moved that much. Right now, valuation-wise, as we've seen, forward PE 36.2 times, EV to sales 5.1 times, EV to EBITDA 22.5 times. The average analyst price target sits just 3.2% higher than the price we're at today. Sales-wise, revenue growth-wise, it's expected to grow between 12 to 13% or so in the next coming fiscal years. EPS in fiscal year 2024 is expected to be down 1.7%, but then it sees a reacceleration of 37% in fiscal year 2025, then another one of 46.2% year-over-year growth in fiscal year 2026. Moving on to Opendoor Technology. So the business there, Opendoor is a technology company, well, sort of, that simplifies the home buying and selling process. You have the Opendoor platform that allows homeowners to sell their homes directly to Opendoor, which then renovates and resells them. Not all the time, but that's basically the shtick here. Instant Offers provides instant cash offers for homes, aiming to streamline the selling process. Home Services offer services like home maintenance, repair, and staging. This is basically the basics of what it does. Of course, you can dig deeper in future videos or your own research. Opendoor right now has a market cap of $1.51 billion. It's down 52% year to date, only up 1.9% in the last 3 months. And here as well, you can see back in 2022, actually, that was the peak for Opendoor for revenue and for gross profit a little bit earlier than the peak for revenue. But yeah, the free cash flows were only positive in the last 12 months, in mid 2023. But from a net incomes perspective, even in the best of times, they did not turn a profit. Right now, of course, no forward PE. EV to sales, it's at 0.5 times for the next 12 months, so definitely not the expensive one out there. Sales-wise, it's expected to be down 25.6% for fiscal year 2024, but then growing 42% year over year in 2025, and then another 29% in fiscal year 2026, while still being unprofitable. Last one here is Redfin. So the business Redfin is another technology-powered real estate brokerage. You've got Redfin.com that provides listings for homes for sale or rent with tools for virtual tours and home value estimates. You've got the brokerage service, so Redfin agents help clients buy, sell, or rent properties, often with a lower commission structure compared to traditional brokerage. And here, Redfin Now, an iBuying service where Redfin buys homes directly from sellers, though this service has been adjusted due to market conditions. And so by now you can understand that both Zillow and Redfin basically left that side of the market for Opendoor. And Redfin right now also has a market cap of $1.14 billion. Years to date, it's down 9.5%. And here as well, unlike Opendoor, but like Zillow, it's up 53% in the last 3 months. Here you can see it as well. It peaked back when rates were quite down, had a small period where free cash flow were positive here back in July of 2023 or so, between July and January of 2024, and also previously 2020 and 2021, but not by much. But yeah, overall net income, not really, although one time, yes, but that's about it. All the rest, yeah, gross profit was okay, and now we're seeing it grow back as we enter the next stage of the cycle. Currently, the average analyst price target sits 27.5% lower than the price we're at today. It has an EV to sales ratio in the next 12 months of 1.9 times. It's expected to grow sales 6.5% in fiscal year 2024, 11.25% in fiscal year 2025, and 8.9% in fiscal year 2026, while of course still being unprofitable. If you basically look, again, the basics of the basics, 3 companies, main differences: 1, Zillow, real estate marketplace; Opendoor, home flipping company you can call it; and Redfin is also a real estate brokerage. Revenue-wise, how do they make money? Zillow, advertising, premium subscriptions, mortgage originations, fees. As for Opendoor, profit from home sales, fees from services; and Redfin, commissions, fees for services, revenue from home flipping. So that's really, in short, what differentiates each and every company and what they actually do, plus some valuation metrics, etc., etc. Now, of course, with interest rates expected to come down, what does that do to these types of businesses? Well, 1, lower interest rates make home ownership more affordable, leading to increased demand. As demand rises, home prices tend to increase, benefiting sellers. Higher home prices and increased transaction volume can lead to higher revenues for these companies. Of course, also lower interest rates, you're more inclined to maybe sell your house, buy a new one, so listings are expected to be higher on these websites as well. More on that in a second. Opendoor may see increased opportunities for home flipping as property values rise, and as more people search for homes, traffic to Zillow's website is likely to increase. A couple of stats from more recently: sales of existing homes rose 0.6% month over month in July, but fell 2% year over year to a seasonally adjusted annual rate of 4,094,991. That's the lowest July level in records dating back to 2012. This is according to a new report from Redfin. And here on the right, you can see new one-family houses sold. That number came in, that came in closer to 600,000. For those of you that want to look at even more numbers, so the median sales price, that's up actually 4.1% year over year, down 0.7% month over month. You have your pending sales, homes sold, new listings, total homes, etc., etc. You can pause the screen and look at all of that. It's quite useful if you're trying to maybe enter those markets or maybe open a position in one of those companies. Now, lastly, a couple of numbers from their latest earnings report. So Redfin, first up here, revenue came in at $295 million. That's up 7% year over year. And of course, you can see the huge difference between, the years of 0% interest rates or close to high interest rates environment. Gross margins are now improving. It's up 70 basis points year over year to 37.1%. Net loss improved quite a lot quarter over quarter, but still a loss, same as basically same quarter last year. And trailing 12 months adjusted EBITDA is a loss of $33 million. Has been improving each and every quarter. As for traffic and market share, for Q2, the average monthly visitor came in at 52 million. That's down 1% year over year. As for US market share by unit, that was 0.77%, up 2 basis points year over year. As for Opendoor, revenue came in at $1.5 billion, gross profit at $129 million, gross margin of 8.5%, which are down from 9.7% a quarter ago, but up from 7.5% a year ago. Net income, but in this case still a loss, also improved quarter over quarter, but last year net income was $23 million. Home sold did improve quarter over quarter, but decreased year over year. As for home purchase, that did increase quarter over quarter and year over year. As for Zillow, Q2 revenue was $572 million, up 13% year over year. Residential revenue was up 8% year over year. Rentals were up 29% year over year to $117 million, driven primarily by multifamily revenue growing 44% year over year in Q2, and mortgages revenue was $34 million, an increase of 42% year over year, due primarily to a 125% year-over-year increase in purchase loan origination volume to $746 million. The increase was partially offset by a decrease in mortgage marketplace revenue. On a GAAP basis, net loss was $17 million or 3% of total revenue. Q2 adjusted EBITDA was $134 million or 23% of total revenue, $41 million above the midpoint of their outlook range, driven primarily by higher than expected residential revenue. Traffic to Zillow Group's mobile apps and sites in Q2 was 231 million average monthly unique users, flat year over year. Visits during Q2 were 2.5 billion, up 4% year over year. This is basically their outlook for Q3. They expect total revenue to be between $545 to $560 million. And so to conclude, I presented here 3 companies. Me personally, if I were to choose one of those companies, it would probably be a company like Zillow, probably over the others. That's just a personal opinion. I think it's a stronger company that would benefit. Of course, all of those companies would benefit from rate cuts, but I think Zillow as a company itself is a much stronger, much stable company compared to the others. Of course, I still would like to see all of these businesses improve from a profitability standpoint. We will probably see this in 2025. The stock can, of course, run up as we've seen right in the last 3 months. 2 of the 3 have already run up quite a lot without the business actually showing us any major improvements to justify those run-ups. But as an investor, long-term investors, if this is a long-term opportunity for you, then of course you would like to see the business metrics do much better. And for that, I think you still have time. You still have time to dig a little bit deeper. But if I were to choose, it would be Zillow. I don't own a position in any of those companies. That's not to say that the other companies will not succeed. No, far from it. That's just my personal opinion. So again, this was also the basics of explanations. I know they probably do a lot of other stuff as well. So please, though, don't be angry in the comment section. All right. If you want to say something, write it nicely, explain why I was wrong or explain what I missed, and I'll be sure to correct myself in the next video. So that's about it from me in this video. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.